Many of you have asked me about my opinion on SPGI stock. The stock is down 21% year to date. Absolutely crazy for one of the widest moat companies you could ever own in the entire stock market. Some of it has to do with their guidance being a little bit disappointing, but a lot of it has to do with the AI sentiment that AI is even going to disrupt SPGI. To me, this is crazy. And this is a very funny quote on X. And he said, you don't need an index when the only company that survives is Anthropic. And there's a lot of stocks going down due to those AI fears. Some of it is justified, but a lot of it, in my opinion, is unjustified. So in this video, I'm going to discuss AI risks, talk about SPGI, and give you my fair value and the upside potential from here. So I really hope you enjoy it as always. SPGI's latest report was actually great. All their revenue segments have pretty much grown 7.9% in total. All their segments have expanded in operating margins. And this is, again, an amazing business model that's very sticky with a regulatory moat and massive pricing power. Now, their guidance was a little bit disappointing, 6 to 8% revenue growth. Normally, the company grows 8 to 10% in revenues. 6% is a little bit low for SPGI. They also guided their adjusted free cash flow growth of mid-single digits, which is disappointing for a stock that was trading at around 30 times free cash flow, or about 27 times earnings prior to the sell-off. Now, if we look at the different segments of SPGI, 36% of the company's revenues, they come from market intelligence. Market intelligence is a massive business for them. Now, this segment of SPGI is by far the most vulnerable segment to AI, as a lot of the value is in searching, summarizing, screening, and drafting company tier sheets, comps, industry notes, earnings takeaways, and many others. Now, modern AI can answer language questions over financials faster than traditional terminals. AI can summarize filings and earnings call. AI can automate repetitive analyst workflows and screening and news digestion. All those kind of things SPGI is offering them, it could potentially be disrupted by AI. So this is a serious risk. Another segment that could potentially be disrupted by AI is S&P Global Energy. Some of it is related to benchmarks, and those benchmarks, in my opinion, are not going anywhere. But there's a side of the business that's between global energy and rating, which is mainly around ESG and sustainability related data. Now, AI makes it easier for customers to build their own ESG scoring from public text plus alternative data. AI could screen the annual report, screen all the information, and it could help you with some kind of a ESG score if you're really desperate for an ESG score. And that was a massively growing business for Moody's and S&P Global, and some of it could potentially be gone to AI. And this is, again, a vulnerable segment for SPGI. Now, my favorite segment of SPGI is actually the index-related segment, as SPGI has over $27.7 trillion in assets indexed or benchmarked to the S&P 500 or to the VIX-rated index or ETFs, and a lot of different royalties and pretty much licenses that S&P collects related to the Dow Jones indices and the S&P 500 in general. And this is mainly a bet on passive investing, which has massively outpaced active investing, especially over the long term, as a lot of the Trump accounts right now, the $1,000 accounts, I believe they're invested in an S&P 500 index, and over the long term is going to create even more and more habits for people to index in those accounts, retirement accounts, and passive investing in general is winning, and SPGI is riding the trend like no one else is doing. Now, another segment, which is the bulletproof and crown jewel segment of SPGI, is the credit rating, because it has a massive regulatory moat. The only agencies that are really allowed to rate debt, corporate debt, government debt in general in the United States is S&P Global with 40% market share. Moody's has 40%. Fitch has 15%. And over the last few years, the government wanted a little bit more competition, so it has allowed more credit rating agencies, which are about 5%. Now, the moat here is so deep that even the 2008 financial crisis, where S&P Global and Moody's, they were pretty much responsible for the crisis because they were getting paid to give good ratings on terrible debt instruments. And even if they caused the financial crisis, they still didn't go under. Moody's is still here, and S&P Global is still here. So even the financial crisis could not destroy the moat of those companies. And that really speaks volume for the credit rating part of S&P Global. And this is only going to expand over time as there's a massive debt maturity wall coming up over the next 12, 24, 36 months, and over the very long term as we have more fiscal spending from the government, we have more spending from a hyperscaler to invest in AI, and we also have inflation, which is going to increase the notional value of the debt, and S&P Global will take a piece of that. So this is really an amazing business. So after reviewing all those segments, we came to the conclusion that the one with the largest AI disruption risk is mainly market intelligence, which is 36% of revenues. But I love looking at them in terms of operating income. And based on operating income, the largest segment is not intelligent solutions. It's mainly the credit rating agencies. This is the most profitable segment, generating $3 billion in operating income out of $6.6 billion. This is massive. So more than half, or pretty much half, their income is from the credit rating, and that's not going anywhere anytime soon unless the government decides to give the companies powers to rate their own debt through AI. But that's not really going to happen anytime soon. So this is not going to go anywhere. The second most profitable segment is the indices. This is my favorite segment, with $1.2 billion in operating profits. So you have $4.3 billion out of $6.5 billion on those profits not going to be disrupted by AI, amazing moat, and massive pricing power. The third largest one is the market intelligence, with about 991 in terms of operating profit. And this is again post-merger because they're spinning off the mobility division, which is also going to include some market intelligence in it. The fourth largest one is the commodity insights, which isn't really going to be disrupted in a major way, with the exception of ESG rating, and the lowest one is the mobility segment. So out of all of them, more than 65-70% of their operating income, they're coming from the rating agencies and from the indices-related business. And those two businesses are not going anywhere. Yet if you look at SPGI's earnings ratio, it's trading at 20 times earnings. I never thought I would see SPGI trading at 20 times earnings. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try it out, they give you 2 weeks of free access if you use my link down in the description. But 20 times earnings is ridiculous. The stock tends to bottom under 20 times. It goes to 18 times, 17 times, and it really doesn't stay there for long. It doesn't spend a lot of time under 20 times earnings. So I'd be shocked if the stock goes even lower. But 20 times earnings is cheap. And this is my valuation model on SPGI. I'm putting in 11% for 2026, which is their guidance, then 12% for the few years after. PE ratio, I'm using 26 times, assuming SPGI gets back to its mean or average multiple of 26 times. Assuming all those assumptions with 1% of a dividend, I'm getting about 107% on the upside, or almost a 16% annual return to buy a wide moat company like SPGI. This is really not bad at all from today's price. But if you're looking for a margin of safety and you want to assume no multiple expansion and it just trades at 20 times forever due to the AI risks, which I would be doubtful of. So this is the worst case scenario. You would have to buy SPGI at 327 or 330 for you to get it double on, again, the most conservative assumptions over the next 5 years. So I believe SPGI over here is undervalued at $401. The worst case scenario is 330. For me personally, I own another index rated stock, which is mainly in Europe, and it's trading at 16 times cash flow, and it's not as exposed to AI as S&P Global, so I'm sticking with my European-related exchange. And if SPGI gets to 350, then I might potentially buy a dip on SPGI. But I share everything I do in my own group, and this is the link if you're interested. Thank you very much for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.